When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron.
Hello and welcome to Moving Iron Podcast. Marcus with Shawn Hackett. Shawn Hackett is with Hackett Financial out of Boca Raton, Florida. It's nice to come on and talk about what's happening in the marketplace. Shawn, how you doing this morning?
Doing real good, Casey. Lots going on.
Just a little bit. So we had the Wednesday had the report come out, and just soybeans got throttled, and I guess everybody realized that maybe that wasn't the right thing to do because they said we'll buy them all back at the original price. So I guess looking what happened, the backlash from on Thursday from Wednesday's report, I guess what's your thoughts there?
You really have to understand what the USDA tries to do. They're just making up the numbers, Casey. They're just making them up. They have no idea what
you finally that's the most honest thing you said on this podcast, Shawn.
I've been saying this for years. They
that's what it seems like. Yeah.
They have an idea of the number they want to come up with. Mm-hmm. So they don't want to come in with 150 million bushel carryout. That means $18 soybeans. They don't want that. They're trying to get inflation down. So you lose 4 million acres, you're in deep, deep trouble. So they go, well, oh my gosh, the demand is just gone. Mm-hmm. Well, all of a sudden, it just within 30 days, you just lost all this demand magically after you found out 4 million acres of less planted. It's just completely making the numbers up. Yep. They decided they were going to keep the numbers around 300 million. Doesn't mean it's true. It's a balance sheet thing, and ultimately the market called it. The market traded it. The speculators traded it, and then they go, "Yeah, that's nonsense," and then they put the market right back to where it started. Yep. So you just have to take these USDA reports with a grain of salt. The USDA is not to be trusted. They're not reliable with this stuff. If anything, they're always behind the curve, and only Pinocchio might have believed that USDA report on soybeans that our ending stocks only going to be down a smidgen with 4 million less acres. I mean, you've got to be kidding me. I mean, that's just a joke. So let's call it for what it is. We have to deal with the USDA. They're there. The markets react. Sometimes they get it right. This was just a made-up number, and we're going to have to obviously look at August weather like we talked about in your last show. And that will ultimately determine, what's really going to happen here. So.
Yeah, and that was the usually when I've seen, and again, I'm not any kind of expert when it comes to watching commodity markets at all, but typically when you watch something like that where there's a report come in and there's just a huge sell-off and everything just goes in the tank, and the very next day it all comes back to the exact same place, that to me it seems like that's a pretty good indicator that things are not as advertised and that there's something there that's driving it back.
Let me put it this way. Cargill, Archer Daniels Midland do not wait for the USDA to tell them what the truth is. I can tell you they're not relying on the USDA reports to tell them what the truth is. They know what the truth is. And so when a market does what it did in soybeans, when they go down, it comes right back up. They're basically telling you that the USDA's numbers are moderately inaccurate.
Mm-hmm. I won't say what my grandpa used to say in these kind of situations on air. So
no, but you know what I'm saying. I mean, the market knows the truth. It's sure. The USDA is always after the fact, and you really think Cargill doesn't have every piece of intelligence on the ground everywhere in the world, knowing exactly what's going on. Well, of course they do. So they viewed that opportunity yesterday with the algorithms selling, because that's what the algorithms do. I don't know for a fact that they were a buyer on that day, but it wouldn't have surprised me that ultimately Cargill and those kinds of people said, "Oh my gosh, what a great deal we got today!" We go buy soybeans because we know that's full of it.
Yeah, exactly.
So,
Yep. All right, so let's talk a little bit about dollar and the strength of the dollar. What you're seeing there. I sent you a text message with, "Oh man, looks like what is lost is found," and you came back with some knowledge that you dropped there about the dollar devaluation and some various cycles that we're going through. The previous what we saw as far as inflationary issues were COVID related and printing money, but this is we're heading into a quote unquote normal cycle of dollar devaluation and inflationary issues. So talk a little about that, Shawn.
Yeah, I mean, there's an 8-year cycle ever since we came off the gold standard in the early 1970s. There's been an 8-year cycle, meaning the dollar rises for 8 years and it falls for 8 years. It rises for 8 years and it falls for 8 years. If you put a commodity chart like the Goldman Sachs Commodity Index over the dollar, when the dollar goes down, commodities go up, and when the dollar goes up, commodities go down. Right. It's just, we know that when the dollar's going down, then foreign prices inflate in US dollars, and we get to sell a heck of a lot more stuff to everybody else because we become more competitive. This has been going on for as long as commodities have been priced in US dollars. What was unusual is that the cycle we had from late 2020 to the top in 22 was not a dollar devaluation cycle. It was a one incident, a one-off thing with this COVID thing that came out and the stimulus that was printed, that we had a wave of, when we reopened, we just had this wave of demand that overran the market. So it was a really unique situation. It was not a normal cyclical move higher in commodities. And now we've had the knockdown. Now we're starting as you said, Casey, a more traditional capital's fleeing the US dollar. It's going elsewhere. The dollar's devaluing, and we're getting commodity related inflation coming back as this dollar's really starting to cave in. What that means is the headline numbers are coming down, meaning the inflation numbers that the government's putting out is falling. Commodities lead inflation by 12 to 18 months. So the decline in the inflation rate now is because commodities have been falling for 18 months, Casey.
Yeah.
So the inflation, but the commodity inflation cycle is now turning back up. The dollar broke a triple bottom this week. Very, very significant breakdown in the US dollar. It is now saying that the $8 down cycle, which bottoms in 2026, we've now entered the next phase. There's also something called the Benner cycle. Benner was a farmer in the 1800s that put together this very unique set of cycles. I actually showed it when we went to present at your at your meeting in Denver, and there's a part in there that has always led to a major U.S. dollar devaluation. And 2023 comes up on the Benner cycle as a year to watch for some kind of a major dollar devaluation cycle. This cycle came up in the early 1970s when we came off the gold standard. It came up in the 1930s when we devalued the dollar against gold. It's been a very, very, in 1985 when the Plaza Accord kicked in and the 5 biggest central banks in the world said we have to devalue the US dollar because it's too strong. 2023 is a year that the Benner cycle is suggesting to look for some kind of an event that creates a major one-time US dollar devaluation, along with the 8-year cycle is now down. So this breakdown of this major support area this week really tells me that we've begun this US dollar devaluation cycle into 2026. 2026, by the way, is the peak in the war cycle, the geopolitical war cycle that is 53.5 years. We peak the war cycle, or the geopolitical cycle, peaks every 53.5 years, which is 2026, which is when the dollar is supposed to reach its low point. Everything kind of fits in with these cycles, Casey, and it has a lot to do with why we've been warning about a strong inflationary cycle from the back half of 23 into 2026. because of all these concurrent cycles kicking in at a time that weather volatility that we've been talking about a lot, that we spend a lot of time working on, is going to continue to escalate and add fuel to the fire. So I think what you have to start thinking about is this. A 2 billion bushel carryout when the dollar is strong and trending higher may mean $4, $4.50 corn. That same fundamental in a declining dollar trend and a dollar devaluation trend could be $6, $6.50. Same fundamentals, much different price. You have to get away from saying, well, because of this carryout, it means this price. That has nothing to do with it. It has to do with the prism that you are filtering the fundamental through to determine the U.S.-based price. If you want to look at soybean prices in Argentina, because the Argentine peso has been in free fall for the last 5 years. It's been going straight up to record highs never seen before in the history of the world in Argentina peso dollars. Of course, we're not seeing that here in the U.S., right?
Right.
Everything is based on the currency that you are pricing your commodity in and what you're looking at. And of course, here in the U.S., trading U.S.-based commodities, what we care about is what the dollar prism is telling us. And what the dollar prism is beginning to start to tell us is that the filter now coming through the prism is going to inflate the price of commodities relative to fundamentals. Now, if those fundamentals get more bullish or more bearish, it's going to adjust accordingly. But we are, I believe we're in the process of filling the tank, filling the tub with more water, where all boats will rise. Some will rise faster than others, but it's an overall repricing of commodities to factor in a dollar inflationary devaluation cycle that once it gets going, Casey, these aren't like a couple of months. These are like a couple of years of this kind of significant devaluation before you kind of reach a crescendo and might reach a peak in that kind of inflationary cycle. So this, to me, says we're about ready to enter phase 2 of this, decade-long move higher in overall commodities. The first one was driven by COVID and over stimulus. This one is going to be driven by dollar devaluation. And then, of course, Mother Nature, being what it is going to continue to, at time, just throw the lighter fluid on and fan the flame out over time. And that's what we have to keep an eye on, that in an environment of dollar devaluation, this fanning of the weather can really get commodities going, because the capital, is going to want to buy commodities to protect against inflation. It's a perfect storm when you get both coming together at the same time.
Gotcha. Okay. All right. One other thing I saw this morning that kind of piqued my interest a little bit, because we talk about the wheat to rice ratio. Wow. Every so often on here. And I saw on here that India is toying with the idea of banning all rice exports out of the country. So looking at the situation that we're in right now, as tight as wheat is around the world, and as tight as rice is for that matter around the world, what's that mean for those two markets?
India has been a big forecast for us. We've been talking about this all through the winter time in our presentations. We've been talking about it here, that India had this unusual 7-year run of unbelievably good weather, like it's never happened before. And they got accustomed to becoming, in many markets, the number one exporter that the world relies on to keep themselves out of trouble. Then last year we had some weather volatility out of normalcy, and they had crops that were just a little, they weren't terrible, but they were just a little bit off. And they partially reduced exports in rice. They partially reduced exports in wheat, partially reduced exports in cotton, in sugar. They're importing milk because of problems with milk production, lack of feed. This year and next year, we're dealing with more of an El Nino pattern, which means that the production shortfalls are going to be much more substantial. And if they were already partially reducing exports last year on modest shortfalls, this year, if they're going to have more significant shortfalls, then they're probably going to have to take exports down, in some cases completely down, or in some cases maybe 3/4 of the way down. And if the world is, in many of these markets, Casey, there's no one to replace that kind of loss. Just to give an example, they exported 18 to 20 million metric tons of rice in the last year. The number one exporter in the world of rice, ×2 above the next largest country, which is Thailand. If they follow through and they just say no more exports, and we lose 18 million metric tons of exports, we need 2 Thailands to overcome that. It doesn't exist.
Wow. Yeah.
It does not exist. Now we'll see how serious they are, and governments do a lot of different things. But what I'm saying is that we believe, everyone's looking at China to save the world and save commodities and bring the demand back, and we've been accustomed to that because since 2000 they've been the main driver for demand for commodities, whether it's copper or it's corn or it's soybeans or it's cotton. We believe that we're transitioning, that India is now going to be the main driver for markets, meaning their economy is growing the fastest. They have the best demographics. And when you go from the largest exporter in the world of many markets to now becoming no exporter or even becoming a net importer, that is a tectonic shift. The last time we saw something like that was when China came onto the scene in the early 2000s and just kind of totally changed the complexion. It looks to me like we get on the other side of African swine fever in China later this year, as we've been talking about. And China says, oh, shoot, we need to buy some more grain. We need to buy some more, stuff. And they start stimulating their economy like it looks like they're going to do. It looks to me like we could have both India and China buying simultaneously for the first time in history in commodities, at a time that weather volatility continues to be off the rails, and it's going to continue to be that way. It really sets up, a very unusual situation for the next several years, because the market is very aware of China. I don't think anyone is really putting together what it means for India to be offline with exports and potentially becoming an importer of some key commodities, including ag commodities. It would be a real dramatic change of guard. And the way we're looking at it, if India is going to continue to grow, if they're going to become, a major global economy, they're going to be a permanent net importer, Casey. There's no way they can grow the amount of food and the amount of commodities that they need with a country as big as they are, with the amount of people they have, with the kind of ground that they have. There's no way they're going to be able to do it. They're going to be becoming a ever-increasing permanent net importer of commodities. And it's possible we may be seeing that inflection point happen right now. Like, you look back and say, this was the moment that shifted, and we never looked back. Just like in 2000s when China became that really big net importer of ag, and we never looked back. That was like the moment of truth that turned the tide in supply-demand equation on the global food chain. I really feel India is the one to watch. It's the sleeper. It's something that really the market isn't really paying as much attention to as I think they ought to. But this rice situation and the wheat situation, in terms of, they really are serious about stopping those exports because of their worries over future food production in the country because of El Nino and other things. Boy, that people are going to start paying attention to that, Casey. You can't, in Asia, I can tell you, if you look at Asian rice prices, they're going parabolically higher. They don't typically do that. The last time we actually had an Asian, remember, it's a cash market in Asia. There's no futures market. There's no algorithms. There's no speculators. There's no funny business. It's a cash market, right? Last time we had Asia get into a tailspin, a shortage like this was 07, 08. And it looks to me like this is, this is the first time since 07, 08 that we're actually developing a serious Asian rice shortage. And by the way, remember last year, China had a 500-year drought in southern China that is starting to show itself in terms of what that means. And, China is buying rice like we've never seen before. And when I look at the weather now in southern China, hot and dry. Not as bad as last year. I want to be very clear. It's not a 500-year drought, but it's not great. They're going to have another short crop at a time that what I'm trying to say is human consumed food, which rice and things like spring wheat and KC wheat, which are mainly consumed by humans. This is a big story. If you run out of corn, you kill the animals. Not that I'm, that's an exciting proposition, but if you run out of human consumed food, Casey, people get very, very angry, and they go on civil unrest, and they go through revolutions, and they blame the people in office for why they can't feed their families, and they're starving to death. If a cow starves to death, it's a different threshold of issue from a geopolitical standpoint. So not only does this have huge ramifications from a humanitarian standpoint, this has huge ramifications from a geopolitical standpoint, what it means for governments, for geopolitical unrest, and all that tends to be inflationary when you start to get those things going, because those who don't have it, historically have gone to war to get it from those that do have it if they are not willing to sell it to them. So I'm not trying to paint this crazy, nasty picture, but history is pretty clear about food leading to escalating geopolitical unrest. 53.5-year cycle comes into view in 2026. I'm wondering if this food escalation of human consumed food shortages is part of that geopolitical cycle that creates that geopolitical unrest and creates that peak in the cycle in 2026. It's all these things are kind of what you look for as these cycles repeat over and over again throughout history.
Yeah. Okay. All right, Shawn, good place to stop. Last time I saw something like this where there was a shortage in supply was 2012, and you saw what happened there with Arab Spring and those kind of things. I mean, that's the same correlators that are coming into play here. So you could see something like that again pop up if, you're exactly right. I mean, people really don't care too much about anything as long as their basic needs are met. And when they're hungry and their kids are hugry, it tends to get them fired up a little bit. So
think of it this way, Casey, it's not, I don't think it's a hugely brilliant point on my part to say that, when the Middle Eastern countries that live in fairly dry climates, who can't really produce a lot of food, who tend to buy or import most of their food like rice and wheat, if those countries get into a pinch on this, what are they produce a lot of crude oil and a lot of energy, and if there's a lot of unrest, then there's a lot of worry about energy production, energy, and then the whole energy side of the equation starts to fire up, and that's an additional element to the inflationary cycle, that if such an important region for energy production is going in civil unrest, then all bets are off about what production and exports look like and access to energy and that sort of thing, and then you have potential. Remember, it was a few years back that's I forget who bombed a refinery in Saudi Arabia, and we had a brief spike in energy price. Those kinds of things could happen again when people get very angry. They're going to attack those that have versus those that have not. So definitely a lot to pay attention to, but I do think that the U.S. dollar devaluation and India becoming a potentially not an exporter and potentially a net importer are two long-term cycles here, Casey, that really bear watching, and I think are the basis for finally turning this 18-month correction commodities around and to go the other way.
Right on. Okay. All right, Shawn, good stuff as usual. Folks want to reach out to you and get more information about what you're doing over at Hackett Financial. What's the best way to do that?
Our website is Hackett, Hackett, advisors.com. We also have a Twitter page at Faradex11. We also have a LinkedIn page on there where we're not habitual posters, but from time to time we will put some information on there that go over our work, our cycles, and our forecast to see if what we do, might be of value to your listeners.
Right on. I'm wearing my pink flamingo shirt for South Florida today, just so you know. Okay.
We appreciate it.
When my wife was dressing me this morning, she pulled this one out. So right on. All right, Shawn, appreciate you being on the podcast, man.
Thanks, Casey.
Right on. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast and check out the YouTube channel over at the Moving Iron Podcast YouTube channel. Go to Moving Iron LLC for everything Moving Iron related and everything. All the information for the Moving Iron Summit coming up here in Nashville, Tennessee, September 11th through the 13th is all up there on the website. If you need more information, send me an email at MovingIronPodcast at MovingIronPodcast.com. I'll make sure to get that back to you. If you want to take advantage of the $50 discount for your registration fee from the folks over at Axon, make sure you do that ASAP, as that is getting full real quick. So if you want to do that, and we just go ahead and register, and you'll be there. If not, you need some more information about it, again, send me an email at MovingIronPodcast at MovingIronPodcast.com. If you like what we're doing here at the Moving Iron Podcast, go over to the YouTube channel and subscribe, and give me a review on all the places that you listen to it at. That sends everything to the top, and more people can listen to it, and the message gets out there further. So with that, I'm Casey Seymour with Shawn Hackett. Let's move some iron, folks. Out.
Moving iron in the 21st century.